Good evening and welcome to another episode of the weekly market wrap. My name is Daniel Ang. Today, of course, is January 25th, and we are only 6 days away from the end of January 2026. And this past week, we did see some market volatility, and the highlight has been what happens in Davos, Switzerland, where the World Economic Forum is being held. We did see some dramas during that few days of that forum itself. Now, today we will do some recap as usual. Before I get into the content itself, let me remind you that this presentation is for informational purposes and it does not constitute a investment or financial offer. Definitely, it is not an offer to buy or sell any kind of financial products here. And my presentation do contain some forward-looking statements, including my opinions, forecasts, and expectations, and conclusion based on some current views and assumptions. These opinions are subject to known and unknown risks and uncertainties, and which could cause actual results or events to differ materially from those expressed or implied. Now, this presentation is general in nature and does not constitute a professional advisory relationship between you and me. Attendees should consult a qualified financial advisor before making any kind of financial decision, especially for investments or trading. Now, as usual, let me recap very briefly what happened the past week. We knew last Saturday on January the 17th, the US warned Iran that all options are on the table as protests gets violent within Iran itself, and there were unconfirmed reports of thousands of deaths caused by the regime on the protester itself, which led the United States to issue such a warning. Then, of course, on Sunday, we have President Trump again threatening to impose an additional 10% tariff on the 8 countries in the Europe that's actually opposed to his idea of annexation of Greenland. So when the market opens on Monday, the following day, on the January 19th, we see the market reacted, especially precious metals. We saw gold and silver surge to fresh all-time highs, and that has been setting the tone for the rest of the week until the end of the trading week itself. So on Tuesday, we have fear gripping financial markets as President Trump doubled down on his threat to use force to take over Greenland if necessary. In the same day, we also saw reports of yields on Japanese government bonds surging to record levels, and that has actually put traders on notice that there is going to be some friction between the yields that we see in Japan and the yields in the United States. As what we know is that the yields has been surging quite a fair bit of late, and that has actually put a dampener on buying US assets. Then in midweek itself on Wednesday, we have reports that the Danish pension fund has announced that they are looking to divest $100 million in US treasuries as a result of that threat from President Trump on Greenland. And of course, we also knew that on Wednesday itself, 21st of January, President Trump arrived in Davos, where he actually made a speech which he basically rolled back on his threat to use force on Greenland. Then on Thursday, we have the revised GDP numbers for Q3 2025, which saw an improvement from 4.3% to 4.4%, which represents the fastest growing economic growth in 2 years, fueled by consumer spending in the States. And on Friday, the market was again on edge. We have Japan dissolving their lower house, getting ready for a snap election on February the 8th, which is next Sunday. Also, the same day itself, we have the Bank of Japan suspected to be intervening in the FX markets when we saw dollar versus the yen collapse by more than 300 points in one session itself. And that has been across the board where the yen strengthened against all major currencies. So this has been the background of what happened the past week. Now let's get straight into the various markets. We have the equity index markets here. And of course, I'm going to expand from the usual four major equity index in the States to cover some regional markets as well. First of all, we have that threat of President Trump's trying to use force to take over Greenland, and that has basically unnerved investors around the world, and that has also led to this new lingo called "Sell America Trade." towards the end of this presentation, I will explain a little bit about what this Sell America trade is all about. And that has been on the back of that threat to take over Greenland at the expense of Denmark. Okay, and we saw that 8 countries within the European Union has come to defend Denmark, or so to say, defend Greenland from being grabbed by the United States. And that has caused a little bit of upheavals in financial markets here. And during his visit to Davos at the middle of the week itself, basically what Trump did was basically to roll back his threat to take over Greenland by force. In his word, he said, I don't want to use force. I won't use force. Now, all the US is asking for is a place called Greenland. So basically, he still wants Greenland. Now he's rolling back on his threat to take over the Greenland by force. Okay, so that has not really solved the problem because he still wants Greenland. The first economic data to be released this past week has been the GDP numbers for Q3 2025. And as was reported during the first estimate, it came in at 4.3%. So the second reading came in better at 4.4%. And if this number does not get revised again at the third reading, it represents the best performance in terms of economic growth for the last 2 years. So this has been the one index, one economic news that has been powering market. In fact, there was a brief moment in which the markets actually tried to break into fresh all-time highs, but somehow failed. Okay, so this has been the news. And of course, the other major data set that we get to know of has been the inflation numbers. Now, this set of inflation numbers has been favored by the Federal Reserve. It is called the personal consumption expenditure, and there has been release of 2 months worth of data. I remember back in October, there was a government shutdown resulting in the incomplete or total lack of collection of data. And so on midweek itself, on January 21st, we saw the release of 2 consecutive months of data sets from October and November. So as far as the month-over-month number, no, we are looking here is a core personal consumption expenditure, meaning to say that it is the personal consumption expenditure minus the food and energy component measured on a month-over-month basis, and that did not register any major change. It came in at 0.2%, which is the same as September. And then in November, it came in at, again, 0.2%. So as far as the month-over-month number is concerned, you can see the chart on the left has gone flat. So it does not suggest that inflation is a problem. However, when we look into the year-over-year number for the month of October, you can see that there is a slight decrease. September was 2.8%, October came in at 2.7%, and then in November it's back up to 2.8%. So by and large, we don't see very large movements as far as inflation measured by the PCE number is concerned. So is that really the case? I have my doubt, but the thing is that the market will look at its numbers and say that now the Federal Reserve will have the green light to go ahead and cut interest rates because inflation is not a thing. Okay, so let's see in the months ahead whether the Federal Reserve will be keen to cut interest rates. Now, when we look into the various major equity index in the States, the one that we always look at will be the Dow Jones Industrial Average. And we can see that the market had an all-time high 2 weeks ago at 49,633. And this week, there was one attempt to rally on Thursday, but did not quite break out. And then on Friday, we did know that prices eased back, and very much there is a possibility of a technical pullback in the Dow Jones itself. Now, this, of course, is based on the daily time frame. Now, I want to focus on these small little prices here, and by referring to the lower time frame, the 4 hours time frame. This is the internal structure of that move that we see in the daily time frame. Now, we can see that there was an attempt to rally. The high traded this past week was 49,607. Not that far away from the all-time high traded 2 weeks ago at 49,633.34. That means that by the time the market closes on Friday, we did see a pullback, and this set the stage for further losses in the Dow Jones, perhaps to challenge 48,428, which is the most recent low. And if that's the case, there's every possibility AB equal to CD move may result in Dow Jones coming back to test the 48,117 to 48,402 levels. Okay, so this could be one possible. Now, the thing is that there is also the possibility of an accelerated move to the downside, especially if the market breaks below let's say 48,000. Okay, that will be a totally different play other than looking at the technical correction here. If the market can hold at 48,100 to 48,400, there is a possibility market may re-challenge the high all over again. Okay. Now, in a Standard and Poor's, which is the S&P 500, we do see something very similar as what we just saw in the Dow Jones. Market have an all-time high at 6,986 2 weeks ago, and there was a brief attempt to rally, but it's nowhere near as high as what we saw in the Dow Jones. And this is also telling us that there's a possibility of a technical pullback that's unfolding as we are speaking. So again, I want to focus on the last few trading days around the all-time high. Okay, so this is the 4 hours time frame. You can see very clearly from the high of 6,986 to the low of 6,789 before the rebound back to 6,934. That is setting the stage for a continued weakness into the coming days and weeks. So if that's the case, we are possibly looking at somewhere between 6,007 to 6,750. If that is the case, unless the market accelerates to the upside and take out the all-time high. But I'm of the opinion that we are probably looking at a period of correction. Okay, so if that is the case, we should be expecting lower prices in the days and weeks ahead. The Nasdaq 100 has been lagging this year. In fact, the high traded for the Nasdaq itself, the high traded was 26,182. That was registered in October 29, 2025. So it means that the Nasdaq has peaked about 3 months ahead of the other two major equity index, referring to the Dow and the S&P 500. Again, there was a rally attempt not too long ago at 25,873, and that has failed. And it's likely to result in further consolidation, maybe with a little bit bias to the downside. And AB equal to CD move from 26,182 to 23,854 from 25,873 may result in a decline all the way down to test the 23,000 to 23,500 levels, which is the blue shaded area here highlighted. Okay. Now, internally, there is a possibility of a smaller degree correction other than this larger degree correction all the way to 23,000. So let's take a look at that possibility. So internally from 25,873 to 24,954, there was a rebound back to 25,709. And if that is the case, that is every possibility we may see further weakness going down to 24,600 to 24,800 levels. So this will be the internal structure of an internal smaller degree pullback other than the lower one at 23,000 to 23,500. So by and large, I still favor the idea that there is possibly going to be continued consolidation in the equity index in the States. Now, this is the Russell 2000, which refers to the small cap index. And I've always mentioned that in an environment where more interest rates cuts are expected, this will be the one index that will benefit the most because they are super sensitive to interest rates movements. And despite the fact that the immediate expectation is that near term, there may not be any movements on the interest rate front. The Russell 2000 continue to trade into fresh all-time high. Now, this contrasts very much against the Dow Jones, the S&P 500, and especially against the Nasdaq 100. Now, while they do not register fresh all-time high recently, the Russell 2000 did so on Thursday with a high at 2,735.1. So this is also the fact that the market is expecting more rate cuts going forward, which favors small caps. So we can see overall the bias is still very much in favor of further gains in the months ahead. But immediately, because of the way the market closes on Friday, it does suggest that there's no follow through in the other major equity index other than Russell. So that results in a bit of a pullback, which may result in further declines in a corrective manner. So again, we want to focus on this smaller area here, and this is the 4 hours time frame. You can see on Friday itself, the pullback was a little bit sharp. Okay, so that create a situation in which I think there will be possibility of further losses ahead in the Russell 2000. The first immediate target is this level here, this red horizontal line, which shows that around 2,600 points, which is this line over here, may offer the first immediate support. Okay, and below here, we probably will see somewhere around the 2,450 levels, which is this other line here. Okay, so between these two potential support line, the market may actually find demands and may actually hold. Okay, of course, if the market accelerate to the downside in a very aggressive manner, then we will have to relook at these possibilities. Okay, Now, beyond the US markets, we are be taking a look at the European markets because this past week, as what we know happened in Davos, there has been a lot of talks about South America trade, and that has largely been the reason why we are beginning to see equity prices falling back. We are also seeing bond prices falling back, and we also see a surge in precious metal prices. This, of course, has a lot to do with President Trump's threat to take over Greenland by force. So we also see that that has negatively impact European equity market as well. So what we are seeing here is the German DAX, which is the German equivalent of the blue chip index, very much in the make of the Dow Jones, for example. So we can see that the high trader is 25,507 and the market has pulled back to 24,350 thereabout before the market attempt to rebound. So we are very clear that despite the positive bias to the upside, we are immediately seeing the possibility of a correction from the high of 25,507. So again, similarly, I want to take a look at the internal structure of this most recent price action here. So in the 4 hours time frame, we can see very similar to the Russell 2000, we saw a very negative pullback oh, sorry. Again, I have to beg your pardon. This is the wrong chart. This refers to the Russell. I should have updated this. But anyway, you can see that price pullback over here is a little bit steep and there is possibility of continued losses towards the 23,500 levels. Okay. So this is the FTSE 100 referring to the UK equity index. We can see that the market actually have a high of 10,257 just 2 weeks ago, and the prices have since pulled back. There was a rally attempt on Thursday, but did not quite robust enough to challenge the all-time high. So again, we are going to look at the overall pattern. The bias is still to the upside, although we do see confirmation of a counter trend developing in the near term. So this is the 4 hours time frame. We can see there was a sharp pullback all the way to 10,050 before the bounce back to 10,226. And now we can see that the momentum is lost and is likely to ease back lower. And if that's the case, there is a possibility the market will test the 10,000, if not the 9,930 levels. Okay, this solid red color line here is the area which I believe is going to be a pivot here. Because previously there was a higher, there was a bottom here. The market actually held momentum really before it surged to all-time high. So on the return leg, if the market do comes back down, this area should be an area of opportunity for us if you still believe this market is going to rally going forward. Now, we extend the look at equity markets around the world by looking at Nikkei 225, which is the benchmark index for the Japanese equity markets. We do see that the Japanese market has been a major beneficiary of the new governments in Japan, helmed by this lady called Sanae Takaichi. She comes with the idea that she wants to stimulate the economy. She's adopting a very expansionary monetary system of fiscal policies. We can see that the Nikkei 225 actually surged to all-time high at 54,570 before pulling back. Now, the pullback is largely caused by her new idea of trying to pause the collection of taxes on food. And we all know that she came in on the platform that she's going to stimulate the economy by a massive amount package amounting to something like 785 billion US dollars. So there is a big stimulus package which need to be paid for. And obviously the only way to pay for this stimulus package is to issue more government debt in terms of the government bonds. However, the Bank of Japan has stated very clearly that they are in no mood to buy more JGBs. The Bank of Japan has been basically the sole single largest buyer of JGBs throughout the years, and they have stopped doing that, or rather they will buy less of those JGBs going forward. Now, the other major buyers of JGBs, which is the Japanese government bonds, has been pension funds and insurance companies. They too have been buying quite a fair bit of JGBs, and those holdings that they have already bought are already underwater. And if they have been marked to market, they will be in serious insolvency. So they are also not in any mood to be buying more JGBs. So if the Bank of Japan and the insurance companies and pension funds are not buying JGBs, then the Japanese government will have to find new way to fund this stimulus package. The obvious way is to sell their massive holdings of US treasuries to support this massive stimulus package that she has in mind. Okay, and that will have repercussion in US bond market as well. And we are also seeing the yield on US Treasury has also been surging, not only in Japan, but it's also happening in the States because now foreign buyers are not buying, and depending on the domestic buyers, they want to be compensated for the increased risk of a US debt. Okay, so what we are seeing here is the possibility that investors are beginning to have second doubts about the viability of this massive stimulus package that the Japanese government is trying to roll out. We also knew on Friday that the government has actually dissolved the lower house and called for a snap election, which will be held on February the 8th, which is next Sunday. So the market right now is of two minds as to whether she will be able to win a workable majority to push through her policy. Now, there is always the risk that she may not be able to achieve that minimum majority. Okay, if that's the case, the market will be chaotic because people will have to readjust the position with the new information. So next weekend is going to be very, very crucial. We will talk about it when we come to it next Sunday. Okay, so here we want to talk about the internal structure of the Nikkei 225. Obviously, it's very similar to what we saw in both Europe and in the States, whereby markets are now likely to go into a period of consolidation with the possibility of lower price action going forward. The Nikkei is have a high of 54,570, and we can see the pullback here to 51,850 before the bounce back to 54,150 is unfolding in what appears to be a likely three-wave move. If that's the case, there's a possibility market testing 50,000. In the intermediate, the immediate support area is these two lines that you can see over here. One is 52,700, which is the upper rate horizontal line, and the lower one at 51,700. So these two lines here, because previously the market has actually reacted, okay, so there's every reason to expect some kind of reaction as the market goes into this area. So by and large, while the prices are likely to fall back into the 50,000 levels, we do see intermediate support around the 52,700 to 51,700 with the ultimate target at 50,000. So by and large, we do see lower prices going forward. Now, the other major equity index I want to talk about will be Hong Kong. Here we have the Hang Seng Index. We see that the Hang Seng has basically gone into a sideways consolidation after achieving a high of 27,381 in the last quarter of 2025. So there were at least two other attempts to break out of the current range. The most recent was the week before at 27,206. The market failed to take out the all-time high and basically ease back. So by and large, when we look into the Hang Seng, it is very clear that this index here has been locked within uh, two barriers. Okay, one represented by the bottom at 25,000, and the other one, of course, is by the 27,200 to 27,400 levels. So unless this situation changes, with either a breakup to the upside or a breakdown to the downside, the market is likely to go into a sideways consolidation, especially when the other major equity index are likely to correct further. So we will likely to see further consolidation in the Hang Seng. So again, we will look into the internal structure by looking at a 4 hours time frame. Here we can see very clearly that it's resistant at the 27,200 levels. Okay, and prices have since eased back. Now, on the lower side, there is the possibility of the market holding at 25,000. So between this roughly 3,000 points range, Hang Seng Index likely to be trading sideways, in my opinion. Okay, so this marks the end of the equity index outlook.